Strategies video, we're going to talk about selling put options. So let's get right into it. So selling puts, also known as being short puts, is a strategy that consists of selling a put option on a stock that a trader believes will increase in price. So selling put options is a bullish strategy. So let's go ahead and look at the strategy characteristics. So the maximum profit potential for a short put is the amount that you sell the put for times 100. So if you sell a put for a $5 credit, the maximum profit you can make is $500. Now the maximum loss potential is the put strike price minus the credit you received times 100. So let's say you sell a put option with a strike price of 100 and you collect $5 for that option. The maximum loss in that case would be 100 minus 5 times 100, which would give us a maximum loss of $9,500. Now that maximum loss only occurs if the stock price goes to zero, which basically means the company has gone out of business. So a maximum loss when selling puts is very, very rare. Now the expiration break-even price is the put strike price minus the credit received. And the estimated probability of profit is somewhere between 50 and 99% depending on the put strike that you sell. So if you sell a further out of the money put, you'll have a higher probability of profit, but with that you'll have less profit potential. Now after expiration, if the short put is in the money, the trader who is short that put will be assigned plus 100 shares of stock. So they'll take on a long stock position of 100 shares. Now in regards to assignment risk, there is potential for early assignment since you are short a put. So if the short put is in the money, you're at risk of being assigned 100 shares of long stock per put contract. Now a short put assignment is only really going to happen if that short put has very little extrinsic value left. Alright, so now that you know the basic characteristics of the short put strategy, let's go ahead and look at a short put example and take a look at the expiration risk profile graph. So in this case we have three strike prices, 23, 24, 25, and we can see the corresponding put prices for those strike prices. In this case we're going to assume the stock price is currently trading for $25 and we're going to sell the 25 put for $2. So we're selling the put option with a strike price of 25 and we're collecting a $2 credit for that option. So let's go ahead and take a look at the expiration risk profile graph for this option. Alright, so as we can see, right off the bat, the maximum profit potential we can make is $200. Now that's because we collected a $2 credit for the 25 put, and the maximum profit is the credit times 100, which is 200 in this case. So if the stock price is at 25 or above at expiration, the short put will expire worthless and the person who sold this put will keep all of the credit that they received. Now, the break even of this strategy is the put strike price of 25 minus the $2 credit we received, which brings us a break even of $23. So if the stock price is $23 at expiration, the short put will have $2 of intrinsic value. All of the extrinsic value will be gone. But since that option expires with a value of $2 and we sold it for $2, the net profit is zero. Now in the loss category, we do see that we have a bit of downside risk. So the maximum loss potential would be if the stock price went to $0, in which case the maximum loss would be $2,300. That's because that short put will be worth $25 if the stock goes to zero, but since we sold it for $2, we only really lose $23 times that 100 contract multiplier. So the $23 loss times 100 is a $2,300 loss. So now that we've looked at a basic example, let's talk about the short put Greek exposures. So now that you know what happens to a short put at expiration, let's talk about how you can figure out what will happen to a short put before expiration. So the best way to do that is to understand a short put's Greek exposures. So first of all, a short put has positive delta, and that's because put prices decrease when the stock price rises, which leads to profits for anyone who is short a put. Since when you sell a put, you want the put price to decrease. If the stock price increases, that leads to a decrease in put prices, which benefits put sellers. Now, on the other hand, when the stock price falls, put prices increase, which leads to losses for put sellers. So the short put strategy has positive delta, so you profit when the stock price increases. Now a short put strategy has negative gamma. Now that means that when the stock price increases, that short put's position delta will get closer and closer to zero, and as the stock price falls, the short put's position delta will get closer and closer to plus 100. Now in regards to theta, a short put position has positive theta. Now that means as time passes, the extrinsic value of that put is going to be decreasing over time, leading to lower and lower option prices. Now, since you're short a put and you want a put's price to decrease in value, that means as its extrinsic value decays away through time, you'll be profiting just from the passage of time because that option's price is going to be decreasing as time passes, all else being equal. Now, lastly, a short put position has negative vega. Now, an increase in IV indicates an increase in option prices, which is bad for put sellers because if you sell a put, you want the price to go down. Now, as IV is falling, that's an indication that option prices are also falling, which is great for put sellers. So when we put all of these together, we learn that a short put strategy can benefit from an increase in the stock price, the passage of time, or a decrease in implied volatility. So there's really a lot going for the short put strategy in terms of ways it can profit. The only way it loses money is if the stock price decreases fast enough to overwhelm the short IV or the short vega or the positive theta. Alright, so let's go ahead and take a look at 3 real short put examples and see how they fared through time as the stock price was moving in each scenario. So let's look at an example where a trader realizes the full profit potential on a short put position. So here's the setup. The initial stock price is $147.23. Initial implied volatility is 43%. The put strike price and expiration is the 150 put expiring in 37 days. Now, we're selling this put for a credit of $8.88. So that means the break-even price is the 150 short strike minus the 888 credit, which brings us to a break-even price of 141.12. Now the maximum profit potential is the credit times 100, which means the maximum profit potential is $888. Now the maximum loss potential is essentially the break-even price times 100. So in this case it'll be 141.12 times 100, which is $14,000 and $112. So that maximum loss potential only occurs if the stock price falls to zero. So the maximum loss potential, as I said before, is a very, very rare scenario because this particular company would need to go out of business in the next 37 days. So that's not likely. So just understand that the maximum loss potential when selling puts is very, very rare, but of course it can happen. So let's go ahead and take a look at this short put position through time as the stock price is moving. Alright, so on the top portion of the graph, we're looking at the stock price changing relative to the short put strike price and the short put's break-even price. And on the bottom graph, we're looking at the price of this 150 put. So, as we can see here, the stock price fell through the break-even price initially, and the short put's price increased from $8.88 to just around $13. So there was an initial loss on this short put strategy because the short put got more and more valuable in those first couple days because the stock price fell significantly. Now, as we can see, the stock price did rally back and was basically hanging around the short put strike price of 150 for a while, but near expiration, the stock price really took off and it was actually above the short put strike price at expiration. Now, as we can see here, as the stock price was increasing and hanging around the short put strike price as time passed, that put options value decreased steadily through time. And since that short put was out of the money at expiration, it expired worthless. So any trader that was short this put over this time period kept the full profit of $888, despite that one little loss right there in the beginning. So this just shows you that when you sell a put, you can still make money if the stock price goes against you or is even, slightly below your short put strike price because as time passes, the extrinsic value of that put will be decreasing over time, leading to profits for a short put seller. So this is just a good example of, when a short put strategy works out favorably. All right, let's get into example trade number 2. So this time we're going to look at an example where the short put is in the money at expiration. So here's the setup. The initial stock price is $673.86. Initial implied volatility is 30%. And we're going to sell the 675 put expiring in 37 days. And for that put, we're going to collect a credit of $24.52. So that brings our break-even price to the 675 short strike minus the 24.52 credit, which brings us to a break-even price of 650.48. Now the maximum profit potential is the credit times 100, which brings us to $2,452. Now the maximum loss potential in this case is 650.48 times 100, which is $65,048. Now that max loss only happens if the stock price falls to zero in the next 37 days. So like I said, it's very unlikely, but it can happen, so we have to point it out. Alright, so let's go ahead and take a look at this short put position's performance as the stock price is moving through time. Alright, so again, in the top part of the graph, we're looking at the stock price versus the short put strike price versus the break-even price of the strategy. And on the bottom graph, we're looking at the price of that short put. So if we pay attention to the top part of the graph for a second, we can see that as the stock price initially collapses, that short put's price actually explodes from $24 to over $40. So a pretty hefty loss in the beginning there. However, the stock price actually does rally back and kind of hangs around the short put strike price of $675 for a while. Now as that's happening, we can see that we actually have profits on the short put position because, as we said before, when time passes, a short put's extrinsic value will decrease, and therefore that will lead to profits for a short put seller. So even though the stock price isn't above the short put strike price and it's actually slightly in the money in that middle period there, the short put holder in this case is actually profiting from time decay. Now, at expiration, we can see that the stock price is below the short put strike price, but is above the short put's break-even price. Now that means this strategy did not realize the maximum profit potential, but it actually did make money because the stock price was above the break-even price. So in this case, the put's value at expiration was right around $10, and since it was initially sold for $24.52, that gives us a net profit at expiration of around $14.52. So the $24.52 initial price minus $10 is $14.52 of pure profit for the short put position. So this just shows you that even if the short put is in the money at expiration, you can still make money on the strategy. Now in this case, since the short put was in the money at expiration, it's important to note that it would have expired to plus 100 shares of stock. So if this short put holder actually held this put through expiration, they would have purchased 100 shares of stock at the short put strike price of $675 per share. Alright, so in this last example, we're going to look at a short put position gone wrong. So here's the setup. The initial stock price is $109.99. The initial implied volatility is 27.5%. And we're going to sell the 110 put expiring in 49 days. And for that put, we're going to collect $4.20. So that brings our break-even price to 110 minus 420, which is 105.80. Now the profit potential on this trade is the 420 credit times 100, which is $420. Now the maximum loss potential is 105.80 times 100, which is $10,580. Now, as I said before, that max loss only happens if the stock price falls to zero in the next 49 days. So let's go ahead and take a look at this short put trade's performance as the stock price is changing. Alright, so just like the last examples, we're looking at the stock price, short put strike, and break-even price on the top graph, and on the bottom graph we're looking at the price of the 110 put. So as we can see here, the stock price kind of meandered around the short put strike price for the first couple days, but then the stock price just collapsed. So when that happened, we can see that the stock price was well below the short put's break-even price of 105.80, and at the lowest point the stock price reached $90, which means that short put was worth at least $20. So this is a big loss when selling a put because we sold it for $4.20 and it actually reached a value of $20 at the lowest point. So the short put's value actually increased by 5x. So this is just an example of how you can actually lose a lot of money when selling puts, but the loss potential is actually less than buying 100 shares of stock at the beginning of the period anyways. So for example, if you would have just purchased 100 shares of stock for $110, your maximum loss potential would be $11,000. However, since we decided to sell the 110 put and collect a $4.20 credit for it, that brought our break-even price or effective share purchase price to $105.80. So since this short put was deep in the money at expiration, you would be assigned 100 shares of stock at the put strike price of $110 per share. However, since you collected $420 in premium, that reduces your effective share purchase price to $105.80. So even though this position didn't really work out the best way that it could, it still allowed someone to purchase shares of stock at a discounted price relative to the current stock price at the time. Alright, so let's recap the main concepts that you've learned from this video. So first of all, selling put options is a strategy used by traders who have a bullish outlook for a particular stock. Now, selling a put option has more loss potential than profit potential, but that translates to a higher probability of profit. So there's always a relationship there between the amount you can make and the amount you can lose, and the probability of making money on that trade. So a trader who sells a put benefits from increases in the stock price, decreases in implied volatility, or the passage of time. Now, those three things give you, a lot of flexibility in the ways that you can profit when selling puts. Now, a short put strategy can be closed before expiration by simply purchasing the put at its current price to lock in profits or losses. So you don't have to hold the short put to expiration. If the profit reaches a certain target of yours or if the loss gets too great, you can always exit a short put before expiration. Now, at expiration, an in-the-money short put will expire to a long stock position of 100 shares per contract. So if you're short a put with a strike price of $125, you will effectively purchase 100 shares of stock for $125 per share at expiration. However, keep in mind that premium that you collected initially actually lowers your effective purchase price of the shares.